I want you to think about a trade you made where everything looked right. Price was going up, chart looked clean. Maybe you saw it trending on Twitter or anywhere in the news. You bought in and then it just fell apart. Here what's probably happened. You read the price, but you completely ignore the volume. And that one mistake, that single thing, is costing retail traders thousands of dollars every single year. I have seen it happen multiple times. Early in my trading journey, it happened to me regularly. So today we are fixing that. We are going to talk about volume, what it actually means, how you can read it correctly, and how to use it to stop getting faked out by moves that looks real but absolutely are not. So let's go. So the first question that comes in your mind, why volume actually matters? So most traders nowadays treat volume like a background noise. It's that the little bars sitting at the bottom of the chart, they glance as it for maybe half a second and then move on. That's completely backward. Here is how I want you to think about it. Price tells you what is happening and volume tells you why it is happening. Just think about an auction. Someone bid $1 million on a painting. Sounds huge, right? But if there are only two people in the room, then the bids means almost nothing. No competition and no conviction. Now put 500 serious buyers in the same room, all bidding against each other. And that's $1 million bids just become a real signal. That's exactly what volume does in the market. It measures participations, and without participations, price moves are basically hollow. The trades in the exchange somewhere between 1 and 1.5 billion shares on a regular day. So when you see a stock spike and that day's volume is 3 times its 30-day average, something real is happening. But when a stock drift up on a volume that is 40% below average, that's not a rally, that's a vacuum. Alright, so let me break this down into 4 specific signals. These are the ones I use personally. And once you understand all of 4, you are going to start seeing the market completely differently. So signal number 1 is high volume and price is going up. This is the real strength. When price is moving up and the volume is significantly above average, buyers are showing up with the conviction. Here institutions are accumulating. That move has actual legs behind it. We can take an example. So in August 2020, Apple ran from $95 to $134 in about 3 weeks, heading into its stock splits. Every measure up day had volume 2 to 4 times the 90-day average. That was not just retail traders getting excited. That was institutional money moving inside. And the volume told you that before anything else did. We can move forward to signal 2. High volume and price is going down. So flip it. When a stock drops hard on a massive volume, that's called distribution. Smart money is getting out. They are selling into the market. And retail traders are buying the dips right into their exit. So we can take an example. In October 2022, Meta dropped from $350 all the way down to $88. The whole way down, every major leg lower was on high volume down days. Every single time volume spiked on a red day, it was screaming that the selling wasn't done. People who ignored that kept catching the falling knife. People who respected it stayed on the sideline and protected their capital. So signal 3, low volume and price is going up. This one is sneaky and this one gets people hurt. A stock drift higher slowly on weak volume looks like a breakout. Feels like momentum is building, but there is no real buying behind it. It's thin air. These moves collapse the second and real sellers shows up. We saw this constantly with small caps names in early 2021. Stock would creep up 50 to 20% over a week on below average volume, suck in retail traders chasing the move, and then just reverse violently. Low volume rallies are not invitation to buy. They are warning to be careful. And signal 4 is low volume and price is going down. Now here is where most people get it wrong. When a stock pulls back, the average trader panics. They think it's breaking down and they sell. But if that pullback is happening on low declining volume, that's not a weakness. That is a rest. The sellers are not showing up and the big money hasn't left. They are just pausing. This is how you find a high probability entries in the strong uptrend. You wait for the low volume pullback, then you wait for the next high volume up day as your confirmation. That's your entry signal. Okay, so here where it gets even more powerful. Layer volume analysis on top of your support and resistance level, and you have got something most retail traders never figure out. I'm going to say you something and I want you to actually remember this. A breakout above resistance means nothing without volume confirmation, nothing. In November 2023, Nvidia broke about $500 for the first time. That breakout came on volume that was 180% above its 20-day average. 180%. That single volume print told you institutional money was moving in size. Anyone who waited for that confirmation got one of the cleanest breakout trades of the year. Now compare that to a stock breaking a key level on 70% of average volume. No confirmation, that is a fake breakout. And the market is full of them, specifically designed to trigger your stop losses and shake you out before the real move happens. Also, and this one is important, watch what volume does at support. If a stock is sitting at a major support level and volume is drying up, fewer and fewer sellers showing up each day, that's called a volume contraction at support. It often comes right before an explosive move higher because the supply is just getting exhausted. Now come to the most advanced concept we are covering today. And honestly, once you see this, you can't unsee it. It is called a volume climax. A climax happens when volume spikes to extreme levels, sometimes 5, 6, even 10 times the average, right at the tail end of the major move. And here is the thing, it looks like conviction. It feels like momentum, but it actually the opposite. It exhaustion. Here is what happening underneath. All the buyers who wanted in have bought. All the sellers who wanted out have sold. The market has absorbed everything it can. And with no fuel left, the moves reverses. Buying climaxes happen at top. Selling climaxes happens at bottom. We can take an example of March 2022. The S&P hits its COVID low on March 23. The 3 days leading up to that low. Some of the highest volume that market had seen in the decade. Pure panic selling. But that climatic volume was telling you something. The sellers were running out of accumulation. Every trader who understood climax volume was watching for that reversal signal, and it came the very next week, launching one of the fastest bull market in modern history. Watch for the climax, it tells you when a trend is running on empty. Alright, let me give you something practical before we close. I have 4 questions. Ask yourself these before every trade. First one is today's volume above or below the 20-day average? That's your baseline. The second question is the price action confirming what volume is telling me or are they contradicting each other? Divergence is always a warning sign. Question 3. Am I near a key level right now? If yes, is volume expanding or contracting as prices approaches it? And the fourth one is, have I seen any climax volume recently on this ticker? If yes, be careful about the chasing. That's it. 4 questions takes you maybe 30 seconds only. But it will save you from that kind of trades that will blown up your account. Look, I will wrap this up simple. Volume is the market lie detector. Price is a story. Volume is the evidence. High volume up is equal to real strength. High volume down is real distribution. Low volume up, potential or trap. Low volume down is a healthy rest. And climax volume, the trend is exhausted. Master these 5 reads and you will have an edge that the majority of the traders never develop. Because most of people are too busy in chasing news, watching Twitter, and staring at their moving averages instead of reading what the market is actually telling them. The market does not owe you anything, but it does leave clues. And the volume is the biggest. If you want to go deeper on this, specifically how to combine volume with the price structure for the actual entries and exit, just comment down and I will make the video for you. I will see you in the next one.